think of the first leases that we've signed over the past year with operators like Sephora, like the Williams-Sonoma Pottery Barn Concepts, Warby Parker. You're seeing these elevated brands that recognize the traffic that high quality food and beverage and high quality service are bringing to complement great anchors at our shopping centers. And we've been a big beneficiary of that.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Brian Finnegan, President and CEO of Brixmor Property Group. Brixmor is one of the largest owners and operators of open-air neighborhood shopping centers in the U.S., connecting retailers and communities across 29 states. Brian is also on the ICSC Board of Trustees for 2026 and the 2026 chair of the ICSC Foundation. Brian, it's great to have you on the podcast today.
Yeah, Sarah, thanks for having me. Great to be here.
So, Brian, at the outset, I wanted to acknowledge the passing of Jim Taylor in June and ask if you could touch on the legacy that he left at Brixmor.
Yeah, thank you. Obviously, we were all very deeply saddened by Jim's loss. He not only had an incredible impact at Brixmor, many lives at Brixmor, but really across the industry. And you could see that in the outpouring of support for his family and for the Brixmor team over the last month. He's somebody who led with great humility. He brought a great culture to the company, and we were lucky to have him in our lives for as long as we did. We miss him terribly, but really grateful for all that he did for all of us, particularly all that he did for me. I'll be eternally grateful to him for it, and our hearts still go out to his wife, Alice, and his daughters, Gracie and Mary Lyle.
Thank you. And Brian, you joined the company as a leasing representative in 2004. And from then until becoming CEO, you've held a number of different positions. It's probably fair to say that you know pretty much everything that's going on at Brixmor. And does that help you in your role as CEO?
Well, I don't know if I know everything, but I've had the benefit of working across the organization. I've been fortunate to work in a number of different parts of the country. This is my 7th city for Brixmor. I've had roles in leasing, asset management, redevelopment, and then previous to my role stepping into CEO, I was president COO role. That does give me some knowledge of the portfolio, the markets that we're in, the team, which really separates us apart. We're a team of operators. And so I've had the good fortune to work with many of the folks at various levels of the organization and really having a sense of what the true potential is of our assets. Also the markets that we want to continue to grow in, markets that we do have a great presence where we have been able to create a significant amount of value. So I do think that's the fortunate aspect of being a company for a long time and working in as many markets as I've been fortunate enough to have.
Excellent. And let's turn to the latest Q2 results and let's look at what they're telling us about fundamentals, looking at particularly occupancy across the portfolio with your small shop and anchor tenants.
Well, we had a great quarter, grew same property NOI 5.8%. We raised guidance for both same property and FFO per share, earnings per share. At the midpoint, we're going to be growing over 5%, same property around 5% in FFO. You mentioned small shop occupancy, hit another record for the company. We did see a little bit of a sequential dip in anchor occupancy. There were some boxes that we took back proactively and some other spaces that we took back during the quarter, which were well on our way to leasing. But we're still ahead of 60, 70 basis points ahead of where we were a year ago. So seeing good trajectory there. And then more importantly, such as the occupancy, the types of tenants we continue to attract to the portfolio and the rents that we're signing rents at the highest level in both anchors and small shops over the past year. So it was really a great quarter. I think what you're seeing is not just a strong environment for open air retail, resilient consumer, which I'm sure we'll touch on, strong tenant performance, but also the benefit of all that our team's done in terms of repositioning our assets to capitalize on the environment.
I wanted to just dig a bit more into the small shop side of things. What do you think is behind their resilience? They've obviously faced lots of challenges in the last few years with the pandemic, but they seem to really be coming out strong.
If you think about our small shops, only 17% of our rent comes from local small shop tenants. So it is primarily national and regional operators, although great local businesses had a huge place in our shopping centers. I think everybody listening can think of their favorite restaurant or their favorite boutique shop. And we certainly have those across the portfolio, but primarily our small shop rent has been driven by regional and national tenants. And I think the success that you're seeing in small shops is really the fact that consumers are just demanding more of the suburbs. And I say that in the way they're demanding higher levels of restaurant, of service uses. And we see that in across our portfolio, health and wellness operators as well, health and beauty. And that consumer demand is leading to us being able to attract great operators at our shopping centers, not just those high quality quick serve restaurants like Shake Shack and Chipotle, Starbucks, which are among our largest restaurant tenants, but also those more elevated brands. Think of the first leases that we've signed over the past year with operators like Sephora, like the Williams-Sonoma, Pottery Barn Concepts, Warby Parker. You're seeing these elevated brands that recognize the traffic that high quality food and beverage and high quality service are bringing to complement great anchors at our shopping centers. And we've been a big beneficiary of that.
And has the work from home trend played into that?
It's definitely played into it. Obviously, I'm at home today. I'm traveling this afternoon. But if you think about a place like New York City, where I'm based, which is probably one of the more significant return to office markets in the country, utilization rates for office are still 31% less than they were in 2019. Just think about what that does. That's a day and a half more that people are home. And what that does for your refrigerator, what that does for your workout habits, what that does for the cup of coffee that you want to get. So we are definitely seeing the benefits of that. We are seeing some level of hybrid work that is stuck. But I think it also goes back to those consumers in the suburbs that are home for a bit more than they were before the pandemic are also demanding a lot more, which has been a big benefit to us in terms of the types of operators we're attracting to our centers.
Great. And Brian, let's talk a bit more about consumers because they're facing inflation, prolonged higher interest rates. How is that all going to play out?
We'll see. I think there definitely is some macro pressure, but we're seeing consumers that remain incredibly resilient. We still have a good job market. Your banks are telling us that credit balances remain healthy. Consumers are spending. We've had over 900 million visits at our shopping center over the past year. Our growth year over year, last month, it was around close to 4%. We've seen positive traffic trends every month of the year. And then more importantly, you're seeing the retailers that are telling us the resiliency of the consumer, the fact that people are still shopping. They may be trading down a bit in terms of what they're ultimately purchasing. And I think it's helpful to think about the consumers that we cater to. Lower income consumers are certainly under more pressure. Our income demographics are 30 to 40% above the US average. So we cater more to that middle upper income consumer, but they're certainly looking for value as well. That helps our off-price tenants. That helps the TJX, Burlingtons, Rosses of the world, which are continuing to open a lot of stores. We've been great partners with all three of them. That helps our grocers, back to that being home for a day and a half more a week. That helps our grocers in terms of what you have to stock in your fridge. There's more prepared foods being taken out of those. And then I do think even though consumers are more mindful of their spending today, you are seeing a higher percentage of wallet share go to health and wellness. So go to their gym membership, go to their service uses. And what that does for us, it also helps complement the quality of restaurants that we bring in as well. So it's something that we watch very closely. We're not seeing any pressure translate into any adverse trends for the portfolio. Small shop move-outs thus far this year are at record lows for the portfolio. Retention rate was up 300 basis points year over year. So it's something that we're watching closely, but really encouraged that the consumers remain resilient thus far.
So are you seeing any major shifts in the balance between the types of tenants that you have?
Not particularly. What I would say is just over the past few years, it is more of maybe some of those elevated brands that are expanding in open air shopping centers and the quality of the restaurant operators that we're able to attract today. I'd say that that's been the biggest thing, as well as the resilience within a number of those core brands that we continue to grow with, particularly on the specialty grocery side. You think of the activity that we've had with somebody like Trader Joe's or the activity we've had with Sprouts. We opened our first new Whole Foods store last year in suburban Philadelphia. It was the first one in that suburb. And just what we've been able to do around that, doing a lease with Barnes & Noble, being able to add Outparcels to the center, like with Shake Shack and others. So I think that aspect of some of those more elevated brands that are continuing to expand their physical store footprint, we've been a big beneficiary of that.
And Brian, any particular changes in terms of tenant site priorities compared to a few years ago?
Yeah, I think the size ranges, that kind of 18 to 22,000 square foot size range, which is where that sweet spot is for those off-price retailers, many specialty grocers as well, whether it's Aldi, Lidl. Sprouts is a little bit bigger than that, but I'd say that size range. And then we continue to see a significant amount of demand from Outparcel pad users. I think we mentioned on our call, we brought a record number of new Outparcels into our active reinvestment pipeline thus far this year. We've done 10 of them, but the demand you're seeing from the likes of Chick-fil-A and from Chipotle, Shake Shack, Starbucks is picking up development again. And interestingly there, if you think about formats, we've seen municipalities be much more willing to allow additional density and allow additional building in the parking lots. So how these tenants have gotten flexible with their footprint to be able to go into what was maybe a smaller parking field before, how they're working with the stacking so it doesn't go out to the street, and being more creative with that to allow more cars to go through the drive-through. That's been interesting as well. We've been a beneficiary of that too.
And that leads into my next question about capital allocation and where you see the highest and best use of funds. Can you talk about the balance between acquisitions, development, redevelopment?
The first dollar for us is going to continue to go to reinvestment. We've invested over $1.5 billion in the portfolio since we started our reinvestment program. But we're even more excited about what we have coming down the pike. We've got over $1 billion just in what is in our active and future pipeline that we show our investors quarterly. And you think of projects like that, half a dozen projects that we've got with Publix, for instance, in both Florida and the Carolinas, other parts of the Southeast. We just launched a project in Metro New York in Rockland County, where we're tearing down a portion of the shopping center. We're coming back with new Outparcel buildings in front of a brand new Nordstrom Rack, Burlington, Ross Dress for Less. We just announced another project in Plano, Texas, in partnership with HEB, where we're repositioning an underutilized part of the shopping center. And this is on the heels of us delivering some very impactful reinvestments in places like suburban Philadelphia, suburban Chicago, Davis, California. We do amazing college towns. So our first dollar will continue to go towards reinvestment because we have several years of visibility into what we have in the existing portfolio. We have been buying more. So for our last 5 years now, we've been net acquirers. We've been finding opportunities to put our platform to work. We did announce 4 acquisitions during the quarter of about $160 million. Long Island, Houston, College Station, Texas. We again do great in college towns by Texas A&M, Panama City, Florida. And these are markets where we have a huge presence, where we see nice rent mark to market. 2 of those projects immediately went into that reinvestment pipeline. So we're seeing some opportunities there. We're going to remain disciplined because we don't need acquisitions to grow. We have internal growth due to our reinvestment, due to our below market rents, and due to a team that continues to drive a tremendous amount of value at our shopping centers. But we've been encouraged by what we've seen on the acquisition front as well.
And would you consider new geographic markets, or you prefer to stay in your core markets?
New geographic markets for us, we'd have to, I think, go in and scale. It's important for us to have a team on the ground that's as sharp as the local owners in those markets and supported by a national accounts platform that can leverage the size and scope of the portfolio that we have as a nationwide company. There are some markets, and I noted college towns. You may see us go into some of those where we don't have a center in the market today, but maybe an hour flight away. Just what we're seeing in terms of the economies in those markets, particularly those larger enrollment Power 4 schools, you're seeing a ton of investment there. You're seeing more of a year-round community. The demographics don't fully capture all the spending that happens in those markets. So I think there's a place you may see us if it's kind of adjacent to a market within an hour flight, like some of the college towns that we're in today. But outside of that, it's been a focus on our core markets unless we can go in and scale.
And Brian, as you make all these decisions, to what extent is AI informing your knowledge of these markets, etc.?
We have definitely been accelerating our use of AI across the platform, really within every function. I'll point to a few areas, but if there's an overarching theme, it's speed. If we want to get leases signed faster, we want to get tenants open sooner, we want to be able to make faster, more informed decisions. So I think the three core areas for us are in leasing legal. Like, how do we reduce that time? We've been reducing time, call it 10 to 15% over the last 2 years in terms of how long it takes us to negotiate a lease. How do we bring that down even further? That's a big focus area for us. In our acquisitions, getting faster underwriting and being able to assess those decisions a lot sooner is a place that we're spending a lot of time as well. And then lastly, we've seen some really nice wins on the operations front, utilizing tools, drone technology, AI technology versus sending people out to assess our parking lots and our roofs. We've been able to cut the cost of that and get assessments that are very similar to what we were doing before that were taking us a lot longer. So it's something that we continue to deploy. I've been really pleased with our team's curiosity and how they've embraced the tools. And we're going to continue to leverage those going forward, but pleased with the progress that we've made thus far.
And Brian, moving beyond numbers and strategy, I'd love to know more about what community commitment means to Brixmor.
Look, I think everybody on the call can recognize what a great shopping center does in a neighborhood. They recognize a great restaurant they went to, the grocery store they used to go to as a kid, where they work out, what a favorite local store is. And we get to do that every day. And that's a responsibility that we take very seriously. One of our cultural tenets is we strive to be the centers of the communities we serve. We recognize we are part of the communities. And for us to be able to really think about what's needed there in a community, what are the uses or what are the business categories that people are leaving that area to go to, or where we may be able to service a need. This is an asset class where it matters who your neighbor is. And so for us to be able to craft a merchandising mix that tenants can complement each other, where there's a lot of success, where we're creating jobs in those markets. And I'm really proud of how our centers look today. They look the best that they ever had. We've invested a lot in the portfolio, and because of all that we've done, it allows us to continue to reinvest in those properties. But it's something that we take very seriously. And I think when you're able to understand what's needed in a community, everybody succeeds. The tenants succeed. We succeed because when they succeed, we get more rent. And then the community's happy because they have great new businesses that are open there as well.
Ryan, as you look ahead, what are you most excited about? Where do you think the biggest potential lies?
I think for our asset class, that gets me most excited is just how our tenants, particularly our larger anchors, continue to utilize the store to connect with consumers wherever consumers want to meet them, whether that's in the store or whether that's shipping from store or whether that's curbside pickup. And the data that they have today to make those stores more productive, understanding what's selling in a given market, understanding what people are ordering online in a given market, and then us having the ability to complement those traditional retail uses that are investing billions of dollars in their physical stores with great restaurants, great service uses, great local and regional tenants. It gives us a lot of excitement in terms of our ability to create those environments going forward. And people, we mentioned hybrid work earlier. What we're finding is people like to get out of the house. People want experiences. They want a reason to go places. And for us to be able to facilitate that gives you a lot of excitement going forward. And I think the other thing is our tenants are succeeding and new and exciting operators continue to want to grow. So that's encouraging for us as we continue to move forward on our business strategy going forward.
And Brian, as I mentioned at the outset, you're chair of the ICSC Foundation board this year. What are some of your goals in that space in terms of helping young people become interested and succeed within this industry?
That's the primary mission of the foundation. ICSC is the trade organization for us in the retail real estate space. And the foundation's primary mission is to attract and cultivate talent to our industry. Our industry is a great place to be. It's like we were talking about earlier, the impact that you can have on communities every day the ability to be at kind of the intersection of commerce and create those experiences and being able to mentor young people and attract a lot of great talent selfishly to either our organization or to the industry in general, I think is vital for us going forward. I was a beneficiary of mentors growing up in the industry. We talked about Jim earlier. He was one of them, many others as well. And to be able to help individuals, and we're seeing the amount of talent now that wants to get into retail real estate, that sees all the exciting things, the demand that's happening within the space is exciting for me. And so it's really energizing. I think there are a lot of things to be excited about the industry, and having the ability to help facilitate that. It's a lot of fun.
Excellent. Brian, thanks so much for sharing your time with us today.
Really appreciate it, Sarah. Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.